All right, warm welcome everybody. Let's quickly take a look where we finished last week across major asset classes before we jump into the week ahead. Now, in terms of overall price action, things were pretty boring last week. We didn't have any major tier 1 data hitting the wires. We obviously had the RBA decision, which did surprise the markets, and the Aussie dollar was the strongest currency on the week as a result of that surprise hold from the RBA, which we'll touch on a little bit later when we talk about the incoming jobs data. We also had the yen being the weakest performing currency, mostly on the back of just further expectations for the Bank of Japan to stay a little bit more patient in terms of recent incoming data, and also the fact that yields, even though we finished very close to flat on the week, yields are obviously much higher compared to what we were just 2 weeks ago. And as a result of that inverse correlation between the yen and US yields, we would expect the yen to trade a little bit softer. We also had a big jolt to the upside in copper prices, obviously on the back of the announcement of that 50% tariff that is planned on copper by the Trump administration. In terms of US equities, things were fairly flat for US equities, to be fair. I mean, if you go back to the last 2 weeks, really, we've just been boxed in very, very tight range when it comes to US equities. We saw a little bit more volatility in European equities, though, with a bit of upside initially in the likes of the DAX and the Euro Stoxx 50. That broke lower as we got towards the end of the week, with some anticipation going into Friday that Europe, just like Canada, will receive a letter outlining the potential tariff that the country or the bloc will be facing from the 1st of August. And that is exactly what we got over the weekend. For those of you who didn't see the news yet, the Trump administration announced a potential 30% tariff on both the European Union as well as Mexico from the 1st of August. Obviously, that is if they don't get some type of deal announced before then. Now, the question is, how is the market going to react to this as we go into the new week? Well, maybe we see a little bit of downside in the euro on the back of that, a little bit of upside in the US dollar, because that has been the playbook for the dollar over the course of the last week or so when it comes to tariff news. But there's two massive caveats. Let's call it three. On the first one, I hope that we get zero reaction from the markets, because we've been waiting and watching for the markets getting more numb to any type of news that we get on the tariff side. And we certainly saw that happen with the Canadian dollar, despite the announcement of that 35% tariff on Canada that we got, the news that we got from that last week as well. We saw a little bit of downside in the Canadian dollar on the back of that, and then the markets kind of just paired that and discounted that data very, very quickly. I'm hoping we see the same thing with only a marginal reaction seen in the euro. That's what I'm hoping for, at least. The other thing is that, when it comes to reaction function, we might not see the markets react that way at all, because remember, back in April, when we heard bad news on the tariff side, the euro actually did good and the dollar did bad, which isn't what we expected coming into this year. So the question is, do we see the euro going down, or do we maybe see it going up? I hope that we see a very small reaction, and then the markets kind of just, goes its way and focuses on the data. That is certainly what I'm going to be doing this week. I will not be trading anything at the open on the back of that news. I will be waiting and watching for the data. Now, when it comes to the data, it is a inflation-filled week this week. We get inflation from the US, we get inflation from the UK, as well as inflation from Canada. We also get jobs data from Australia, and we also get the earnings season in the US ramping up from this week as well. So let's start with the most important one first, and that is, of course, US CPI coming up on Tuesday. Now, this print and the next two CPI releases from the US will be very important for markets, because the Fed right now, we know that they are in wait and see mode. And the markets, if you take a look at rate expectations, the markets are still pricing in about 50 basis points worth of easing by the end of this year, right? So this report and the two after this will basically make or break the current rate cut bets for the rest of the year. The big question is whether the tariff shock from Trump's trade moves that we've seen, whether it finally starts to make its way into consumer prices, or whether we don't see that happen at all. If inflation does start to heat up it means the Fed has been right to basically stay patient, and that could mean staying on hold a little bit longer, and obviously the dollar could catch a bit on the back of that. But if Powell is wrong about inflation, and instead we see continued disinflation when the markets are expecting a bit of a move higher, then obviously that means the White House will have even more reason to push for Powell's replacement, and that could be a negative for the dollar. Negative on two fronts. Obviously, firstly on the policy side, because if inflation does go down, it does open the door for more cuts, which should be bad for the dollar. But at the opposite side, if inflation does go lower and we do see a push for Powell's replacement, that the dollar could take a second slide on trust erosion, because that will the markets will basically see that as the president trying to hijack policy decisions that are supposed to be made independently. So that lack of trust, I think, is a very big negative for the dollar should we go into that type of cycle. So that is the bottom line. Is there's a lot to focus on for the sprint. Now, in terms of broad expectations, we can see markets are already geared towards a hot print, which is interesting, right? We can see that for core month-over-month and year-over-year, inflation is expected to tick up 0.3 for the month-over-month, 3% core expected, which is interesting. Headline expected to go from 2.4 to 2.7. So the bar is already set for a bounce in CPI. But remember, I think this is an important thing to keep in mind. Even at the current levels, even if we just get a as expected print of 3% on the core and 2.7 on the headline, that'll still be seen as hot and inflation moving in the wrong direction, right? So even if we get an as expected print, I reckon that in itself could provide upside moves for the US dollar, which, as we know from a positioning point of view, has been stretched for quite a while now, right? The markets are sitting on a very, very sizable net short position in the US dollar. So obviously, I'm hoping that inflation comes in hotter than expected, because that'll give the markets even more reason to look for upside in the dollar. But I reckon even an as expected print should, on balance, be positive for the US dollar. Now, there's a couple of things to note about this CPI under the surface, which was quite interesting when I did my research for this. There's a couple of participants. If you look at ING, Scotiabank was another one, Monex was another one as well. They all agree that tariffs are no longer just talk, right? They're starting to creep into prices according to their initial assessment, and they expect that June may be the start of that, let's call it that pass-through effect from tariffs into both core goods as well as headline goods. So it's going to be very, very interesting. Also, when it comes to seasonality, June CPI often, not always, but often comes in soft due to how it's seasonality or how it's seasonally adjusted. So if we do get a hot number, despite that, it also, just adds to the impact that we could see, even if we get that as expected or consensus print. Now, let's quickly take a look at what markets are pricing in. Markets are pricing in a whopping 93% probability of a hold for that July meeting. There's another 50 basis points priced by the end of the year. But obviously, if CPI surprises massively to the upside, the markets might start to nudge that 52 basis points expected by the end of the year. The markets might start to nudge that a little bit lower, right? The markets might go from, pricing in 50 to maybe only pricing in 45 or maybe 40. Then the question will become, are we going to get one cut or two cuts, right? That could obviously be very positive for the US dollar. On the opposite side, like we said, if we do see a downside surprise, I reckon if it's a big enough one, especially with the markets expecting inflation to come in higher, if we don't see that and we expect or instead see inflation see further disinflation, meaning we don't see the pop to the upside that the markets are expecting, then obviously that could see the market starting to price in a fair chance of a cut even for that July meeting. So that is definitely something worth watching. Now, obviously, when it comes to market positioning, when it comes to pricing against the US dollar, when it comes to rate expectations, when it comes to all of these, attacks that we've had on the Fed and on Fed Chair Powell, I'm really hoping and gunning that we get a hotter than expected inflation print. I'm hoping for something above that 3% maximum, that 2.7% maximum for the headline. If we can get core coming in at 3.1%, maybe even higher, but I would take 3.1. I think that could be really good for the US dollar. It should be enough to see some of those bears just squeezed a little bit out of those positions, and that in itself could be really good for upside in the US dollar. What if inflation doesn't move higher? What if we actually see it moving lower? I would expect downside, and if that happens, I would obviously look to get out of my current dollar long as quick as possible. But even if it is, I won't be looking to short the dollar on a miss, but I would be looking to get out of my long if it's a miss, just because I don't want to be short this with the market so short the US dollar right now. I think that is it's a continued risk. Even though a miss should obviously see downside for the dollar, I won't be looking to trade that. Also keep in mind that if we do get that hotter than expected print, how would we expect other asset classes to react? We would expect things like yields to move higher, bonds to move lower. If that's the case, we would also expect that to provide a little bit of downside pressure in the likes of US equities. Now, I don't think hotter inflation is a reason to be short equities in the medium term. But in the short term, with equities back to all-time highs, it might see a little bit of a shakeout to the downside, right? It might be enough to see us finally break out of this short-term range and maybe retest back down towards those prior all-time highs. So for the ES, on this chart at least, it would be 61.43. For the NASDAQ, it will be close to 22,222. So lots of twos there. And obviously for the Dow, that could be closer. We still have to get back to all-time highs at 45,100. But if we do get a massive miss, we could steer our way back towards that 43,300. Now, there's a lot of focus on the Dow this week with earnings, but we'll get to that a little bit later. So that's the focus for US CPI. That's going to be the main focus point for us this week. The other one that we have coming up on Wednesday is UK CPI. Now, at the Bank of England's last meeting, they obviously held rates steady, but the markets viewed the tone of that meeting leaning slightly more dovish than expected. We had 6 of the 9 MPC members voting to hold, and 3 obviously wanted a cut, but they did acknowledge that the labor market is loosening and growth is looking a little bit sluggish. So right now, the bank is basically just like the Fed. They're waiting for more evidence to feel more comfortable before they cut again. And inflation is going to be the main evidence that they are waiting for. Now, here's the catch. The BOE thinks that CPI will rise again temporarily due to the higher energy and regulated prices like water bills, etc. But they also say inflation risk are two-sided, meaning they're not sure, right? They think it's going to go higher, which is why they've opted to stay a bit more patient. But they are just as concerned about inflation potentially undershooting as it is overshooting, which is quite interesting. So that makes this print, it's going to be a bit of a coin toss. I mean, even a small miss will further green light that August meeting for the next cut, which is already priced at 76%. If it's a hotter than expected print, look, unless it's a massive one, it shouldn't be enough to sway the markets away from looking for an August cut, but obviously it won't be sitting at 76% if inflation comes in higher. The point is, the Bank of England expects inflation to go up, but they have steered towards a potential cut. So it needs to be really hot for them to change that and for the markets to change its view on that, which means in a week like this, the more attractive opportunity would be for a miss in CPI to see the markets fully pricing in a cut, pricing in more easing by the end of the year, as opposed to pricing in less. It just makes it a little bit more attractive. What's also good on that front is that when you look at positioning, the market's fairly neutral. Let me just quickly go there. Where is position? The market's fairly neutral when it comes to pound positioning. So if you really wanted to trade it higher on a beat, you certainly could look for something like that. But in my opinion, I would rather be looking for a short. If it's a miss, I just think that feeds into the current narrative a little bit easier. It feeds into the recent language that we've heard from the Bank of England a little bit easier as well. I just think it'll pack more punch. Look, rate markets already priced for a cut at 76%, right? So if it is a miss, we might not see as big of a move in terms of the short-term expectations. It'll just see the market seal the deal for an August cut. But think about it this way, because the bank expects inflation to go up towards the end of the year, if inflation starts to decelerate a lot faster than they anticipate, then surely that means they can add a bit more. They could go for something a little bit faster than the 1 cut per quarter that the markets are currently expecting. So that is something that I'll be watching keenly if we do get a miss. And obviously, if US CPI does come in hotter, then pound dollar downside looks attractive. We are making our way steadily towards that next major level of support around that 134.30, and if that falls, the next stop could be back down towards 133, 133.50. So a lot to play for to the downside if we get a beat in the one and a miss in the other. The other CPI print that we get, I believe that would be on Tuesday as well, is Canadian CPI data. Look, I'm not too excited about this one. For the main reason is the market. I don't think the markets will be focused on this as much. Let me explain. If we take a look at what's priced in, the markets are pricing in another 22 basis points worth of easing for the Bank of Canada, right? Now, that's until the end of the year. There's 4 more meetings. So my thinking when it comes to the tariff situation currently, right, is there's new developments that we had last week. It's the 35% tariffs, potentially starting from the 1st of August. There's 4 more meetings left, which means that regardless of the very hot jobs data that we got on Friday, whether this week's print is hot or not doesn't really change much for the Bank of Canada, because they would want to wait and see what happens to August the 1st. Right? They have all the reasons to stay patient, wait to see what happens to tariffs. If the tariff situation does play out after this end of July meeting, then obviously the next focus point will be on September, and then they would have a new batch of jobs data, they would have a new batch of CPI data. There's a lot they can do with the new information in September. There's not a lot that they can do by the end of July. So obviously, because we had the jobs data surprise to the upside, there has been some participants in some reports saying, hey, you know, if CPI is hot, if we get that core number, that preferred core number, which is the average between CPI trim and CPI median, if we get that at 3.1% or 3.2, maybe, you know, that could see some upside. And sure, you could play for some upside in the CAD, but personally, I'm just going to ignore that one, because again, I don't think anything that we get this week from the CAD or from Canadian data will change the BOC's mind. I think they stay on hold at the end of the month. They wait to see what happens with that August 1st deadline, and then September meeting will be live, and then we can take things from there. So not expecting anything from that Canadian CPI data. Now, the other one that we get, we obviously have US PPI data coming out. That's not going to be too much of a focus with CPI in the mix. We also have UK jobs data. Now, look, when it comes to UK jobs data, the ONS doesn't trust the jobs data. They are the ones that release the jobs data. Because they don't trust the data, the Bank of England doesn't trust it. Because of that, the markets doesn't trust it. So there won't be a lot of focus on that. The two things that will be interesting will be the wage data. But again, wage data will only be tradable, in my view at least, if CPI the day before comes in with a massive miss. That's a big miss. Then we'll be looking for further miss in the wage data to add to pressure in the pound. But if the UK CPI data comes in as expected, I won't be looking to trade the jobs data at all. So just keep that in mind. The other things we get is retail sales, fully fed. Again, those things won't matter as much as CPI this week. The other focus then will be Aussie jobs data that we get. Now, the reason why this will be interesting is after last week's RBA surprise that we had. Last week, the RBA defied market expectations and kept interest rates on hold when everybody was looking for a cut at about 96% chance. This was yet another example of how bad central bank communication can be at times, and how it can play games with the markets, you know, arguably costing a lot of people, not just traders, a lot of regular people, a lot of money, because they just don't communicate properly. But I'm not going to allow myself to go into a rant about the RBA and how bad they were in previous years and how bad last week's decision was. That's just going to take up way too much time, and I'm sure all of you know exactly how I feel about that after last week. But anyway, let's turn our focus back to the jobs data. Currently, markets are still, despite last week's hold and despite the pop to the upside and despite the fact that the Aussie was the strongest currency on the week last week, the markets are still very short on the Aussie dollar at the moment. In terms of market pricing, despite what happened last week, the markets are still pricing in close to 60 basis points worth of easing by the end of the year. And there's about an 83% chance that we get a cut in August. Now, what makes this print interesting is I think this print will only matter if it's really, really bad. But even if it isn't, the RBA has already told us that their main focus, at least, overnight, their main focus has shifted to the quarterly CPI data that we only get at the end of July. So if we were to get a better than expected print, could that see further upside for the Aussie? It could, but I wouldn't look to trade upside in the Aussie on a beat, personally, because the markets, despite what happened last week, still see a high probability of a cut playing out for August, and a better than expected jobs print won't necessarily change that view because the markets are waiting for the quarterly CPI data, just like the RBA is. So in that sense, I think despite positioning still stretched, the more attractive opportunity could be a massive miss in the data, because how will the markets view that? The markets will view that saying, hey, the RBA could be behind the curve. They should have cut last week when everybody was expecting them to. They didn't. Now they've got egg on their faces because jobs data are deteriorating massively, right? So think about the repercussions. If the markets, despite what happened last week, is still looking at 60 basis points worth of easing, so 3 cuts by the end of the year, or close to 3 cuts by the end of the year, then a better than expected jobs print isn't going to change that. A weaker than expected one will just add to the conviction that, they made a mistake, they should have cut rates, they didn't, now they probably have to cut more with the remaining meetings that we've got left for the year. So I would prefer, because I have a downside or bearish bias on the Aussie Kiwi, I would prefer a massive miss that shows the bank might be behind the curve, that sees markets potentially pricing in more cuts by the end of the year. I would prefer to use that as an opportunity to short something like the Aussie Kiwi, because I do think that policy divergence between the bank is still very much in play. Obviously, last week we had the Aussie ramping up on the back of the Hull decision. We had the Aussie catching up to a bit of that upside that we had in copper prices. There was a lot of reasons why this pushed up, positioning being another reason. But now that we've had a move to the upside, now that the Aussie has caught up to copper, if the jobs data comes in really bad, I think that's a far better opportunity to look for downside. Now, what if the data is really, really good and you really do want to buy the Aussie dollar? I would probably prefer to trade that against the euro. If US CPI comes in hotter than expected, I would expect that to create some downside pressure on the euro, and that could be good for euro Aussie downside if the Aussie data is really, really good. But again, my preference would be downside Aussie Kiwi if the data comes in really, really bad. Now, the other driver that we just need to watch in the week ahead, apart from obviously ongoing tariff developments, will be earnings. Earnings season kicks off a little bit more earnestly this week. We get all of those big bank names coming up on Tuesday. We get JP Morgan, Citibank, Wells Fargo, BlackRock. We also get things like 3M, Netflix, Johnson & Johnson. All of these names, Goldman Sachs, are very important. More so this week for the likes of the Dow Jones. Why for the Dow Jones? Purely from a weighting point of view. If you take a look at the S&P, most of these names are in both the S&P as well as the Dow. But because the Dow is price weighted, while the S&P is market cap weighted, in the Dow, these names matter a lot more. So for example, JP Morgan has a close to 6% weighting in the Dow. Goldman Sachs, the biggest one for the week for the Dow, has a close to 14% weighting. 5% for Travelers, 3% for 3M, 6% for American Express. So these names matter a lot for the Dow this week. So regardless of what happens to CPI, we have to keep an eye on these earnings names as well, because they can impact moves in the Dow Jones as a result of these big weightings. So with that said, there's a lot to focus on. Obviously, first focus will be what happens at the open. I'm hoping to see very limited reaction from the markets on the back of that. And then the attention, assuming the markets have a very small reaction on at the open, then all of the attention will turn to that incoming CPI data and obviously earnings data as well. So I hope everybody will have a fantastic week ahead. And as always, any questions, don't hesitate to let me know.